Welcome to Every Dollar Counts with Josh and Jay, the shot of truth serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, Director of the Gulf Coast for Concourse Financial Group. We are brought to you on the Gulf Coast Financial Advisors Podcast Network. Well, with the recent stock market volatility, Jay and I are going to tackle an issue that many investors are feeling right now, possibly some of them for the first time in their investing experience, and that's risk tolerance. So we're going to tackle what is risk tolerance? Why does it matter when you're setting up your investments? How do you determine your risk score? Jay and I are going to actually go through one of my risk tolerance questionnaires you can find on my website, gulfcoastfa.com, to help you all understand why risk tolerance is such an important factor when you're settling your investments. But before we get into all that, though, let's have our friends from Sloth Racer kick us off. Jay, buddy, how you doing today?
Josh, doing well. Good to be with you here in studio at Deep Fried with Johnny and crew, enjoying the start of spring, and looks like some of these May showers are coming in a little early.
Yeah, coming in a little hot here, but hopefully we got some good weather after that. So, well, quick housekeeping for compliance. Jay Stubbs and Concourse Financial Group are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Knoll, I'm not affiliated with Concourse Financial Group. So, Jay, we're going to discuss today risk tolerance, risk score, and the genesis of it is something that you and I deal with on a daily basis in our particular industries, but we had a guest on a previous podcast episode, and that was one of the things that she asked about. You know, should my investments be more risky? How do I determine that? How does it look, sound, and feel? So what I'd like to do today is we're going to walk through what is risk tolerance, what's that mean when we say it, and then we're going to go through a brief exercise of you and I determining our scores on risk tolerance, because it'll probably surprise some people. And then we're also going to relate that to folks at different ages, particularly when folks are starting to hit the retirement red zone. But before we lay all that out, let's start with this. When I say risk tolerance or risk score, what do I mean?
Josh, risk tolerance can be anything. Some people listen to this may say, well, am I a risky individual? Would I jump off a cliff into a pool or into a river or into a lake? When we talk about risk tolerance on this show, Every Dollar Counts, we're clearly talking about your money and your ability to earn a dollar on a dollar. So capital working for you in the marketplace. Some people have to understand that if I put money into a stock market, individual equity position, an individual stock, we're not making recommendations that anyone should or shouldn't. That could potentially be a risky position depending upon the company that they're investing in. Our good friend Will Stye says, does it pass the quote unquote pillow test? Meaning when we fall asleep at night, laying down, thinking about all the things going on in the world and maybe our cash and our equity positions, are we nervous about a position somewhere, some investment we've made? Some of it has to do with disposable income. You know, do we have enough money to make it the next week, the next month, the next 6 months, or the next year? And others have to look at risk tolerance and address that towards their goals. What do they want to have at the end of a time frame? So for a lot of us listening on this show, it might be a retirement planning goal, or it might be a savings goal towards a new home, or perhaps a child or two and their education fund. What do we do with the dollars today, putting them at risk or not at risk in order to grow to attain that goal? Clearly, risk tolerance means we've got to decide where that money goes to work for us. So yeah, I think it's fantastic that you've got a risk tolerance questionnaire. It used to be the old rule of take your age, the number 100, and subtract your age, and that means that would be your risk tolerance. So if we take my age, 45, and subtract that from 100, then we have a 55 potential risk tolerance grade. That's just a very, very simple way to say that 55% of what I put money into needs to be a little bit more conservative, with 45% being a little bit more aggressive.
Well, and with that said, so I've got two parts on that. So as you and I have seen, the age is an important factor when you're allocating your portfolio over time, especially, as we'll touch on later in the episode, when you hit the retirement red zone. You're 5 years or less before you actually retire. But Jay, you and I have also seen is age is not always a super accurate indication of how much risk someone can tolerate individually. Risk tolerance is unique to each individual.
Absolutely.
And, you know, we have in our particular lines of work, we have people in their 30s that are very conservative. We have people in their 60s that are, some would point out and say that's actually fairly risky behavior with your investments. So risk tolerance is a unique thing, kind of like a snowflake to each person. And the reason I want to stress that is because a lot of times people come in and they're worried about what they should be on their risk tolerance. What should I be? How do I compare to other people? So on and so forth. And my thing to them is it really is individual to you, because if you push the envelope and get a little more risky because you think that's what you should do, are you going to lose sleep over those investments? Or is it going to bother you when you check the numbers? And especially with the volatility we've had recently, you're seeing pretty significant swings back and forth during that day.
And is it going to impact someone else?
Yeah.
You could have a family, married, not married, kids, not kids. Is your risk or dollars you put at risk going to have an impact somewhere else on their financial situation? And another thing to consider, Josh, is what is the ultimate goal of the dollars that we're putting at risk? For some, in their qualified plans, might be their 401k or their IRA, they know for a lot of folks listening that you're not probably going to touch those dollars until you're 59 and a half or older. And if you're like me, 45 years old, you've got at least a 15-year time horizon on those qualified plan dollars or those IRA dollars. So I might be a little bit more risky with those because my time horizon is further out, versus that non-qualified or that savings or investment account that is there to be as a backdrop to my regular income coming in monthly.
That's right. For many investors, particularly those that contribute to a qualified plan like a 401k or an IRA, it really does come down to what is the purpose of the money. And as my friend Tim Hake says, it's not so much the volume of the money that's there, it's what income stream does that money produce if that's the goal of that money. So with that, Jay, you mentioned time horizon. I want to touch on that. A lot of times when you hear someone talk about risk tolerance or risk score, they'll also bring in time horizon. And here's why. Most people understand that you're going to have a risk versus reward type of scenario when you're looking at investing. If you're 70, 80, 90, 100% in equities, that is ownership of individual companies on the stock market through owning individual stock or having mutual funds or ETFs, if you're in that realm, then you're going to have a higher degree of risk versus somebody that has more fixed instruments like bonds and things like that. So why that matters is you can never predict the market, and Lord knows we're not going to do it on this show, but when you look at any time period of the stock market, 10, 15, 20 years plus especially, it tends to follow certain patterns. And what you really want to look at is if you've got the time horizon, if you've got 10, 15, 20, 30 plus years, you have time to weather the ups and downs of the market, particularly the downs. We've seen that even in an extreme example when you and I were in studio March of 2020. Is that right?
Absolutely.
Gosh, it's been that long. When we had COVID hit the world and the market the bottom fell out. Well, for most people, thankfully the market came storming back. But for the folks that were earlier in their investing career, you've got time to absorb that hit and let the market do its job over a long period of time. That's why we always mention time horizon. On the flip side of that, it's a little bit different conversation. We'll talk about the retirement red zone, Jay. It's a little bit different conversation when you're talking retirement red zone, because now you're starting to get to the point where not only do you not have the time to weather that downturn, but you're not actively contributing to that plan anymore. In fact, you're actually actively taking deductions out of that plan. So now we've got sequence of return risk. I don't want to get too nerdy on this podcast, but let's talk about the retirement red zone and how that plays a factor in risk tolerance for those folks.
Yeah, retirement red zone is a phrase that I heard probably 10, 15 years ago that referenced individuals or couples who are nearing the time where actually they're going to pull the retirement chain. They're actually going to stop working and start using or drawing income from their retirement accounts and their other assets in order to enjoy retirement. The retirement red zone is typically a 5-year period. So if I'm 60 and my plan is to retire at age 65, I am now in the retirement red zone. And I've got to make decisions along with consult with my advisor, such as you, Josh, that says I need be a little bit more conservative, take a little bit more risk off the table, because you just nailed it on the head. I may not have the time to build back up any losses or volatility that have hit my accounts. So retirement red zone's 5 years. Now, I'd like to clarify that. some people have said, I am definitely going to be working the rest of my life.
Right.
However, there is a large chunk of money that may be used to help me not have to work if I don't want to. So you're still that individual or couple that's in a retirement red zone. And again, that's a 5 year. So you could be 35 years old and saying, I'm stopping work when I'm 40. You're in the retirement red zone. Congratulations to you. But I don't know too many people that have done that. I know a couple, but really and truly, we're talking about 55, 60, 65-year-old folks listening to this, then, and you're planning to start slowing down, you're nearing the retirement red zone, or you are in it. And it's highly important that you have a conversation with an advisor to make sure that your portfolio is positioned in a manner that the risk has come down.
Very good. Very well said. And Jay, before we get into the actual risk quiz, I got one more point to make, especially for you investors that have a little bit of time horizon ahead of you. Always remember that when you see the market gyrate like it has recently, especially when you see what used to be historical dips, it's kind of funny how we've got normalized to the Dow going down 500 to 800 points in a day. But just remember, it's not a loss unless you sell. It's really important to remember that. It's not a loss unless you sell. In fact, if you're positioned right and you're actively contributing, you actually have an opportunity to buy things, what you hope as a long-term discount, because you have other people selling on the other side. Some would call it buy the dip. It's not, you don't just do a buy the dip as an overall financial planning strategy. But the point of that is, remember that it's not a loss unless you sell, until you actually realize that capital loss. And there, a lot of times in those particular situations, there are some opportunities to get in if you're careful and methodical about it. And it's one of those things that it doesn't matter if it's investments, it's anything. When there are more people selling than people buying, that creates opportunities for those that are positioned to do so.
And one other thing that advisors typically will have someone do is talk about dollar cost averaging. And so, Josh, as you said, it's not a loss until you sell a position in a fund or an ETF or a stock or what have you. It's also a well-known fact that if you dollar cost average, put in a regular amount, whether that's weekly, monthly, quarterly, you are doing that on a regular and systematic basis. Not only does it get you used to it in your budget and your spending for your household, but it also helps you go in at different points of time during performance. So dollar cost averaging is something or strategy that a lot of people will use for their IRA contribution. We certainly know what dollar cost averaging, how it works in our 401k contribution, because if you are in a participating 401k, then you know every time you get paid, some portion or percentage of your paycheck goes into that 401k plan. That is dollar cost averaging.
By definition. Very good. All right, so Jay, let's jump into my website. And I have in the upper left-hand corner, so my website is gulfcoastfa.com. That's Gulf, like Gulf of Mexico, Coast, and then FA is in financialadvisor.com. In the upper right-hand corner, you'll see a button that says, what's my risk score? So Jay and I are going to do a couple of these things quickly, and we'll see if we have any surprises on our own risk score. Because to be honest, I haven't done my own in a long time.
No, and things are different. I was a lot different at 25, 27, 30 years old than I am today at 45 with 4 kids.
So let's have a little fun with this. So Jay, we'll go through this quickly. In general, if your best friend described you, would they describe you as a risk taker? Would they say that you're a real gambler, that you're willing to take risks and after completing adequate research, that you're cautious, or you're a real risk avoider? How would they describe you?
I'm going to take that risk after I do adequate research.
Very good. Okay.
Now, keep in mind, my comfort level with things that we're talking about today is very high. So my research, you and I have access to go and read about funds, about ETFs, about positions that we might consider for ourselves. So I would be considered after research. I would be willing to take some portion of risk.
I think that's great. And I have a two-part answer, so I'm splitting hairs here. But I think my general friends that are not clients would consider me a little bit of a gambler because I was willing to move down here, not know anybody, open a business, grow it, and so on and so forth. But my clients definitely know me as somebody willing to take risks after completing adequate research. So you and I match there. All right, here's the next one. There's 4 answers to this, 4 potential answers. You're on a TV game show and can choose one of the following. Which would you take? Would you take $1,000 in cash up front? Would you take a 50% chance at winning $5,000, a 25% chance at winning $10,000, or a 5% chance at winning $100,000?
I'm going to answer, given my situation today, I'm going to say I'm a 50% chance person.
Very good. Okay. So that's a little more conservative, I wanted to guess.
It is. I want to be able to walk away because if I'm putting time, energy, and effort into being on a game show, I want to walk away with something.
Here's where I have a little bit of a funny take. I've always told myself if I ever get on a game show, no matter what, I'm just going to push all the chips to the center of the table. I'm going to let it ride.
That's where you and I are a little bit different.
Yeah, because if I'm going down, I want to go down in flames. I want the audience to remember me. Either I won a lot or I lost my butt, and they're all cringing at home. All right, very good. All right, next question. 3 weeks before you leave on your dream vacation, you lose your job. 4 answers. Would you cancel the vacation, take a much more modest vacation, go as scheduled, reasoning that you need the time to prepare for a job search, or extend your vacation because this might be your last chance to go first class? That's good.
I'm going to keep the vacation because obviously, married with 4 kids, everybody's probably going with me, and that would be a severe disappointment to everybody going on that trip. So I'm going to keep it. More than likely, I've already pre-funded it or paid for it because of planning that we would do. For instance, we're headed out for a trip here in a few weeks. Pretty much everything's taken care of, planned, and paid for. So I'm going to be that person that would continue the trip, and I'm going to use that to kind of decompress, let my hair down a little bit, do some soul searching, some thought searching, and see where I would land next with respect to my career or in the same industry, if even at all.
So you would go as scheduled, reason that you need time to prepare for a job search. That's where you would land.
Yep.
Now, this is going to be funny because this is going to be a direct contradiction to where I said before, but I'd cancel that sucker. I've not had a quote-unquote real job since I was in my mid-20s, and so the idea of me not working for 3 weeks and then having some time off, I'd have a real hard time with that. Even if like I've done in certain parts of my life is, I've actually jumped back on an asphalt crew and I've ran heavy equipment. If I feel like in how I'm wired, I have a very hard time relaxing on the vacation.
Well, there's a difference. And people listening, if you're an owner operator of your business, then you're more likely to stick around and keep working your day to day.
There you go.
If things have happened where you feel a little uneasy about taking that extended time off, whereas me as a W-2 employee for a company, I feel a little bit more comfortable doing that. People would know that I do work hard, but maybe taking a week or 10 days off is something that I would need to refresh.
Very good. We'll do 3 more, Jay. A relative left you an inheritance of $100,000. Now you need to choose between these 4 options. Would you invest all in a savings account or a money market fund? That's money market's going to give you at least a little bit of guaranteed interest. Would you invest all in a mutual fund that owns stocks and bonds? We could throw ETFs into that mix as well. Would you invest all in a portfolio of 15 common stocks, or would you go all in on commodities like gold, silver, and oil?
I think that question answer depends. It depends on if I have any debt that I want to service or pay off. But just taking the question as you listed there, I'm going to choose, I think it was option 2, which is I'm going to allocate it into a portfolio of funds and ETFs.
We matched there, 100%. Yeah, that's. I'm comfortable with individual stocks. But I do like having some diversification, quite honestly, because I've set my practice up in the same way as I'm wired. I hate to see the bottom fall out of things. I feel like that's money that's been hard earned, whether I earned it myself or if I ever did receive an inheritance from my family, I know that they earned that money with their blood, sweat, and tears. So yeah, I would definitely want to have some preservation, or at least some diversification so the bottom didn't fall out. All right, 2 more questions. Jay, when you think of the word risk, which of the following words come to mind first? Loss, uncertainty, opportunity, or thrill?
Well, back in the 20s, the risk was thrill. In the 30s, it was opportunity. Today, at mid-40s, with, again, a large family to take care of, it's uncertainty.
Yep.
Do I want to put that uncertainty on my family, my household? As kids get older, I may gravitate back from uncertainty to opportunity, especially if maybe college is paid for or things are looking good financially. So I'm kind of in between uncertainty and opportunity. However, for today, I'm going to stick with uncertainty.
Uncertainty, very good. I did opportunity, so there's split the difference there. Very good. All right, we'll finish with kind of a convoluted question, but it's fun. And again, folks, these is my risk score, my risk tolerance questionnaire on my website, gulfcoastfa.com. You can go in there, you can do it anonymous, or you can put your information in if you want to have a conversation. The upper right-hand corner, just click the button. All right, Jay, this is a long one. Your trusted friend and neighbor, an experienced geologist, is putting together a group of investors to fund an exploratory gold mining venture. The venture would pay back 50 to 100 times the investment if successful, but if the mine goes bust, your entire investment is worthless. Your friend estimates your chance of success at only 20%. If you had the money, how much would you invest? 4 choices: nothing, 1 month's salary, 3 months' salary, or 6 months' salary.
Well, again, it depends on maybe that neighbor, and I will check my neighbor's lifestyle. But at the same time, I also... Again, I'm back to that question we originally asked on, would you do a little research? I'm going to do a little research. If I deemed it a viable opportunity, not necessarily uncertainty, I'd probably do 3 months salary.
3 months.
Yep.
Okay. Wow. All right. So this one's going to throw you off a little bit.
Now, here's why.
Okay. Yeah. So let's hear that. Well,
I'm in a position that I'm working, I'm active, I have regular income coming in, and there are other assets on the table. If I didn't have a penny to my name, I'm not going to be risking 3 months salary.
very good.
But you ask me as a personal question, I would say 3 months.
3 months. All right. So I would be one scale under that. I'd say 1 month's salary because I'm always, I'm always a little nervous when somebody comes up and asks me for money because it happens a lot in our world.
Yeah.
And I always have a couple different questions for them. One of it is how much of your money is in this venture? And, if they're not willing to put almost all in on their own thing, then I'm always a little dubious. Again, it kind of depends on the person and the personality and the lifestyle, like you said. And the other thing is going to be like, how are we tracking this? I mean, Jay, in your line of work and my line of work, and I don't mean to pick on anybody in particular, but how many times have you had somebody come with a spreadsheet that shows just total sunny roses on the returns and all that, and you're just like, man, have you ever done this before?
Yeah, those return spreadsheets that give us opportunities for, this is what this thing can do. Yeah, I'm always skeptical, especially if you hear it maybe on a late night radio show or a late night TV show. And there's a lot in the news right now revolved around cryptocurrency. We're not going to get into that and discuss it, but there's a lot of people who are considering that as an option for part of their investment strategy. A lot of the millennials and younger generation are considering that, and they make it easy for you to get into. So again, I'm going to be skeptical, and I'm going to want to do my research before I put my hard-earned dollars into anything. Now, that was a little off the table with respect to the 3 month salary. Keep in mind my salary, but then I have if we really wanted to truly answer that question, I'm paid based on opportunities that go in place, so my salary is a lot lower than most people would think.
All right.
So I get incentive pay on top of a base salary.
All right. So if you're scoring at home and trying to figure this out, it's on a 0 to 100 on a scale. So we'll reveal Jay's score first. So in our risk tolerance score, if you're 0 to 42, you're very low on the risk tolerance that you can handle. Low would be 43 to 50, moderate 51 to 62, high 63 to 78, and very high 71 to 100. So with that said, Jay, where do you think you're at?
I think I probably landed because in between moderate and high. Am I close to moderate?
You are a 68. You're in high. You're on the high end of high.
That's because I answered a couple of those questions a little bit more risky than normal.
Well, and here's the funny thing. I'm at a 78, which I would not have guessed. If I had a little more time to go through this, I would be more in line with your score because I've had enough life experience where I've made money and lost money. So I tend to be moderately, growth oriented, but without pushing it too far. And that's kind of how our practice is set up too. So, all right. So folks, we tried that as quick as we could. Hopefully that was fun for you. If you want to do your own risk tolerance, again, go to our website. And Jay, let's go ahead and wrap up the show because that took a little bit of time. Let's wrap it up with, hopefully you all understand a little bit more about risk tolerance. And as you have seen, here Jay and I are close in age. I'm a little bit older than him. And, we're close in lifestyle. We're close in our life experiences and things like that. But we still had different risk scores. And so that should hammer home the point that it really depends on the person. And the main thing is, Jay, I always tell people, don't apologize for how you feel. You want to trust your gut when you're doing these scores, because at the end of the day, when the money is either going up or down, or if it's growing slowly and you don't see a lot of loss or as much loss when the market bottoms out and you're more comfortable with that, that's okay. There's nothing wrong with that. I'll give you final word.
And you might have different risk scores for different components of your portfolio. As I mentioned earlier in this show, the difference between a non-qualified asset and a qualified asset. Those retirement dollars may have a different risk score associated with them than they would maybe your savings and investment account that's there for your rainy day fund or your backup to your regular income. So different folks have different opinions on all the matter. The important point here is do the risk questionnaire. If you're married, do it with your couple as a married couple and discuss all facets of risk. Make sure that you're in agreement and then make some decisions with an advisor, somebody like a Josh at Gulf Coast Financial Advisors that says, here's some things that we can consider, and then look at your options moving forward, form a strategy, form some goals, and implement a plan. Yeah,
married couples typically, they usually don't land at the same place. Usually one's more conservative than the other. We always just advise, hey, let's try to find the middle ground here where you're both comfortable, where one side doesn't feel like they're leaving anything on the table and the other side doesn't feel like they're exposing themselves too much to risk. And then one last little point before we wrap up. I think, Jay, you've seen this in your own line of work, but business owners, it's kind of funny. Typically, business owners, when it comes to their actual market investments, tend to be a little bit more conservative. And I think that's a product of the fact that they have a lot of risk. A lot of times they have a lot of risk in their business ventures, but they have more control over that. Is that fair?
That's fair.
Yep. All right. Well, listeners, if you'd like to continue this conversation, you can always reach out to us. You can call 251-327-2124 and leave a message, or you can visit my website, gulfcoastfa.com, to set an appointment there and obviously do this risk score. If you want to reach out to Jay Stubbs, you can catch him at jaystubbs.com, jaystubbs.com. So thanks to all our listeners out there. Many thanks to Johnny Gwynn here in Deep Fry Studios, our producer. Thanks to my co-host, Jay Stubbs, and to all of you all that have been out there listening and been with us on this journey and or just joining us on this journey. Thank you. And to those of you that are joining us now, do me a favor. Please subscribe on the Apple Podcasts app or wherever you get your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.